Good afternoon. You're watching us here on Halftime Report, the last trading session of summer 2079. I am Manglam Malu, with me Ekta Batra. We're looking okay for the market, though we've come off a tad from the highs. As we speak, the mid-cap index actually has moved into the red. And, the broader markets where we saw more stocks gaining than losing have now moved into an even keel. As we speak, the red and the green crisscross lines come up for you, and we see them at a split right down the middle. We're coming closer. We have still some more stocks advancing than declining, but that ratio is narrowing. Hi, Ekta.
Hi, Manglam. Yes, absolutely. It's been an absolute fantastic run, at least for the financials at this point in time. So that's really what stands out. We have the Bank Nifty, which is up around 1.7%, and courtesy stocks such as Axis Bank, which is fired away, up around 6% currently for Axis Bank, top gainer on the Nifty. And that seems to be going strength to strength. A lot of the banks have reported numbers till now. Net interest margins at multi-quarter highs, advances at multi-quarter highs. So that gives you a sense in terms of the kind of fervor a lot of the financials are seeing. But we do have a big company lined up.
We do have a big company lined up, Asian Paints. That's the one which is losing in trade today, as the company's second quarter earnings were below street estimates. The stock is at the low point of trade. In fact, lost about 2.5–3% yesterday as well. Cross margins declined to multi-quarter lows. The volume growth is likely around that 10% mark versus street expectations of 14 to 15%. Amit Singhal, the MD CEO, joins in. Mr. Singhal, 10% volume growth on a 20% sales. That means realizations were very weak this time. You've taken a 20–25% sort of price hike. What explains these weak realizations?
So overall, when we see, I think we saw very strong inflationary trends in Q1, up to almost about 6% inflation in terms of the overall material prices. This was followed by another 2% inflation in Q2 in terms of what we see. As you know, in the paint industry, there's a lag which really happens in terms of the inflation really hitting you to that extent, because there is a inventory of raw materials and finished good which carries into the next quarter literally. So what we saw was an overall impact of at least about 7% happening in Q1 and Q2 on Q2 to that extent. And we have taken price increases of about close to about 2% in Q1 and about another percentage in Q2 to that extent. So a 3% increase against almost like about a 7.5% inflation in terms of what we see impacted us. So I think that has taken a toll with respect to the overall gross margins. If you see, there is a deficit clearly of about 4.5% in terms of what you see to that extent. And therefore, we feel that that is one factor which has impacted the overall margins to some extent. Obviously, we have spent a sizable amount in terms of our marketing expenses and overall stuff to that extent. But I think the larger impact is of the real inflation which has kind of hit in. I would say that under the circumstances, a 10% volume growth and a 20% sales growth with a PBT and a PAT of about a 23% growth on standalone is a very, very strong performance which comes in, because if you look at from the point of view of even H1, we are sitting at almost about a 37% value growth and about a 24% volume growth overall, which possibly gives us a kick in terms of the market shares which we have gained in the first half of the year.
Okay, all right, Mr. Singhal, that point is taken. So your price hike wasn't sufficient as compared to the inflation, but did you grow faster than the industry?
So our estimate is that definitely we would have on the volume front grown faster than the industry to that extent overall as we see it, because if we see this quarter is largely a stocking quarter in which July and August are stocking months and September is the real retail month which kind of comes into that extent. September has been a little weak because of the extended monsoons which we have been seeing to that extent, and therefore what we see is that what we have been able to achieve in this quarter would be leading the market for sure.
Right. And, how about the third quarter? I mean, we're 20 days into October. How has the performance been? There were, reports of extended monsoon in the first half of October as well. Has that impacted performance?
But I think the good part was that given the fact that there was an impending Diwali and homes have to be painted and so on and so forth, we did see a surge in the last about 15 days for sure in terms of the overall sales, which has come in to that extent. But to us, I think overall what matters is that I think the month after Diwali is even sometimes bigger than the Diwali month overall in terms of what we see in terms of the large amount of sales which kind of come in, which is for larger average size painting sites to that extent. So what we see is that October till now has been going well overall in terms of the festive sales, which have picked up really. And overall going forward, there are a lot of factors which are working well. First, the wedding season seems to be very, very strong this year in Q3 as well. The construction is picking up. Our B2B business, the projects business has been doing extremely well, outgrowing the retail sales to that extent, and therefore given the kick in the real estate despite the interest rate going up, I think that's a very strong area which is kind of auguring the demand. And lastly, I would say that a good monsoon which has happened, relatively good monsoon, is a very big kickoff on in the consumer sentiment overall in the rural markets. And I think that will definitely give us a higher growth from a rural point of view to that extent, which also has been incidentally the trend in Q2, where the rural markets have done much better than the metro and the T1, 2 tier cities.
Okay, all right. Mr. Singhal, I just wanted to loop back with regards to the margin picture. If you could give us an outlook with regards to the margins post the price hike that you've taken. Gross margins are around 35%. You said that a normalized level for you will be around 39 to 40%. So how soon can we get back to those levels?
So if you see Q1, we were at 19.2%, and even overall in terms of the gross margins were closer to about 37, 38% kind of a zone, which were there to that extent. We feel that this is a transitional part happening given the larger impact of inflation, which is coming in. The markets are now, raw material is cooling off very strongly. We see definitely a deflation of about at least minimum about 5 to 6% happening in the coming quarter, which we see in all the key raw materials of the paint industry overall to that extent. And given the fact that today, I think the maximum brunt of the inflation we have taken in Q2, and we are done with that kind of an inventory which was there in our system, I see definitely going forward that there will be definitely a push up in terms of the overall gross margins, more towards possibly to a 37, 38 kind of a percentage point, and definitely an improvement in terms of the PBTIT margins going towards the band which we spoke of in Q3. But I see that possibly if the inflation kind of remains flat and the deflationary trend continues, I think by Q4 definitely we will be back in terms of the bands which we have been speaking of definitely.
Right. By Q4, you will be back in the bands that you've been talking about, 18 to 20% EBITDA margins, and 37, 38% sort of gross margins that you're talking about. But let's talk about the big news, the capex that you announced. A lot of that was backward integration to cut costs and be a cost leader. I mean, was that organic, or you did that because competition is heating up now?
So overall, at Asian Paints, see, we have always looked at backward integration as one of the areas. We have been always making our own emulsions, which is the backbone of any paint formulation, which kind of goes into that extent, and also a significant cost of the paint formulation to that extent. We have not kind of suddenly come out with this backward integration. It has taken us about a work of almost about a year and a half in terms of what we have been working on all these innovations which we are thinking in terms of backward integration. So whether it is the vinyl acetate ethylene emulsion in terms of what we are bringing into the R4, or it is a white cement, or it is the nanotechnology which we are boosting up our core business with overall, what we see is these are all strategic decisions from the point of view of not only in terms of improving our cost efficiencies and improving our margins going forward, but also able to offer differentiated, standout products in the market. And that is something which is a key endeavor in terms of innovation that we want to take into the market. And we see that some of these backward integrations are also giving us flexibility in terms of imparting some never thought before kind of innovations in terms of product categories at a very, very strong cost advantage, which would kind of really make us really stand out in the market, as we have always been doing to that extent going forward. And given the leader in the market, we will always have pressures from here and there, which will keep on coming. But I think so long as our strategy, the brand, the supply chain efficiencies continue, and we kind of concentrate in terms of looking at a sustainable cost advantage, I think we would be possibly ahead of the market. And all these are in that kind of area in terms of what we are looking at.
Okay. Mr. Singhal, a little more on your diversification, or rather your backward integration. You're not a market leader when it comes to the white putty space. Birlas are, and the Birlas are eyeing the paint space. What is that strategy about? Is this some kind of a tit-for-tat strategy here?
No, I don't think so, because see, today white cement goes into a lot many powder paints which are there, and not only in putty, it goes into our textures in terms of construction chemicals, tile adhesives, and a lot many areas to that extent. We don't want to compete really with anyone in a cement space, because the larger market there is grey cement. If we have to compete with someone, we would have got into a grey cement space rather than a white cement space, which is a very small market overall as compared to the grey cement market. So to that extent, I think it is very clear that we want to prop up our overall cost advantages. We want to look at innovation in our product categories. And that is why we are seeing that anything which is substantial from a point of view of raw material contributions is something which we want to kind of really explore going forward. And that is something which we will continuously do, because I think the future is definitely saying that, can you get a lead from a point of view of cost advantage, which is sustainable in terms of going ahead. And sustainability can only come in with large investments in terms of what you make, where technology is at the forefront and opportunity is something which you are kind of taking.
So short point, Mr. Singhal, what does this mean? I mean, you spoke in the conference call of these integration projects actually improving your gross margins or giving you an advantage of almost 500 to 600 basis points. So what does that mean? Do your gross margins actually go higher from here, or is it just enabling you to maintain margins at current level while increasing volumes? Just wanted to understand the thought process there.
So overall, if you look wherever we would kind of use the this emulsions, overall the white cement, and going forward, I think in all those products, we will definitely see a gross margin improvement of about 4 to 5% definitely happening in those products. We will have to see in terms of what those products will kind of contribute to the overall mix of the organization to that extent. We think that definitely it will give a boost in terms of the overall gross contributions. Very difficult to say at this point of time how much really to that extent. But I'm saying that today, we will continuously maintain that band in terms of the 18 to 20% of PBDIT, which we have said. And definitely going forward, this will help us maintain that cost leverage and advantage in that band as we go forward.
Take that point, Mr. Singhal. Always a pleasure speaking with you. But the point that Mr. Singhal made about, growing faster than the industry at 10% volume growth as well has had its effect on all the other paint companies. So Berger Paints, for instance, is now at the low point of trade, sitting with a cut of almost 5%. Asian Paints, of course, is not doing well because the growth was slower than what the street was expecting, especially on the margins front as well. And now Berger Paints feeling the heat.
Welcome back. Well, for the mid caps, it's absolutely flat at this point in time. But just watch out for a couple of these stocks which are reacting to numbers. So DB Corp came out with its numbers yesterday. That stock is up around 9% or maybe 8% at this point in time. It's rallied almost 30% this year. So the street really likes the numbers. Ad growth was quite steady. It was up around 26% on a year-on-year basis. Consolidated revenue was up around 20%. So despite the profit declining around 9% on a year-on-year basis, it seems as though the street was quite enthused by these parameters, such as ad growth, which seems to have probably revived on a year-on-year basis. But let's get talking to another mid-cap. or another broader market company, Suzlon Energy 1,200 crore rights issue has gotten oversubscribed by around 1.8 times. The issue saw a subscription of around 435.5 crore shares. To discuss more on this, the company's fundraising plans, we have with us Himanshu Modi, who's the CFO of Suzlon Energy, joining in on the show. Mr. Modi, hi, welcome to the show. If you could just detail to us, it's around a 1,200 crore rights issue. You had mentioned last time that you would be using majority of the funds to repay debt. Just list out what exactly the fund utilization would be for Suzlon now.
So, firstly, on behalf of the entire Suzlon management team, I'd like to thank all the shareholders for the confidence and the overwhelming response that we've seen on the rights issue. I think this is a very strong testament to the entire organization and a strong tribute to our founding chairman, Mr. Tulsi Tanti. So, through the process of the rights issue, the rights issue size was about 1,200 crores, of which we are making the first call for about 50%, which is 600 crores. And a large part of that, other than issue expenses, so to the extent of 585 crores, would immediately go towards debt repayment out of the first call.
So, just wanted to understand that if I look at your finance costs over the last few years, FY20 was closer to 1,400 crores, FY21 sub 1,000 crores, FY22 735 crores. First quarter, you did about 150 odd crores. Annualize that comes to 600 crores. But, after that, you've done a lot of debt repayment plans, you've done a lot of refinancing, etc. So where does this quarterly finance cost settle? How much can that number be for this year and going forward?
So Q1 of FY23 won't be a barometer, so I don't think it's fair to analyze the interest cost basis Q1, because there was a refinancing exercise, a large refinancing exercise that the company undertook in May 2022, which is halfway through the Q1. If you see our overall debt as on June 2022 on a consolidated basis, stood at about 3,200 crores. And through the rights issue, assuming now the entire call on the rights issue is made, approximately about 900 crores is what we are looking to repay the debt from the rights issue proceeds. So, and of course, there are scheduled repayments through the FY23 cycle. So, as I mentioned last time, we'd be directionally looking at a debt to EBITDA of anywhere between around close to 2:1. And our existing debt stands at about 9.5% to 10% in terms of costs. So on an annualized basis, even at 3,200 crores, which is pre-rights issue debt, our finance cost should be around 300 crores, which would significantly now come down once we repay the debt through the rights issue proceeds.
Okay. So if we were to have the same conversation, same time next year, Mr. Modi, guide us as to what your balance sheet would look like and what might your order book look like as well.
So same time next year, of course, from an interest cost perspective, I think we are working towards further optimizing the balance sheet. It would be, of course, even less than 2:1 debt to EBITDA. So I think, directionally, one should be looking at close to about 200 to 250 crores in terms of interest costs on the company. So far as the order book is concerned, the foundation of the company is fairly strong from a technological perspective, or ability to execute the projects is very strong and robust. What was ailing the company historically was its balance sheet and the debt on the balance sheet, which now after the rights issue has significantly been resolved. And therefore now the focus would be only on order execution. So from an order book perspective, as on June 30th, 2022, we had an order book of close to about 700 megawatts. There are about 2 or 3 orders rather we've announced subsequent to that. So our existing order book sits a little shy of about a gigawatt as we speak.
How much is operation and maintenance as a percentage of sales? How much does that go to from here? Because that also helps in reducing your fixed costs.
Welcome back. Well, it's all about the financials. Well, we do have IRB infra numbers on your screen as well. Good growth in terms of the net profit, 85 crores versus 42 odd crores. And the margin should come up for you as well. So that's the Q2 performance. Revenue down around 8.3%, but they've done well in terms of profitability. So let's see what they deliver in terms of margins. EBITDA down around 7 odd %. So let's see if there's any kind of exceptional in the bottom line. But nonetheless, it is a lot about the financials. So I just want to pull up one particular parameter with regards to the financials. Remember that a lot of the banks have already reported numbers. There's Axis, IndusInd, Federal, all of these banks have already reported numbers. And if you just look at the kind of advances growth they've all reported, and I'm not talking about the net interest margins as well as the NII, all of those parameters have been at multi-quarter highs, is just strong advances growth that all of these banks have reported on a year-on-year basis. Besides that, remember that ICICI, Yes Bank, RBL, all of these banks are reporting numbers in the next couple of days. And just to give you a sense, ICICI Bank is holding very steady ahead of its numbers, so up around 1.7%. Is generally Axis or ICICI tend to be precursors for each other in terms of expectations. But let's talk a little more about Axis Bank. Abhishek is here with us to tell us what we can expect in terms of the Q2 performance, or rather how the Q2 performance was. Abhishek, over to you.
Well, for Axis Bank, it's fired on all cylinders or across metrics if you take a look. So net interest margin is at 26-quarter high of about 3.96%. The NII growth on a sequential basis came in at close to 10.5%, which is the best in 26 quarters, and around 31.1% on a YY basis, which is the best in last 25 quarters. This has helped the return ratios with ROA of 1.8% and ROE of 18.5%, both being one of the best in last 7 years. So asset quality has been pretty good. The gross NPA ratio has declined to 2.5%. So X of Q2 FY21, which was the RBI dispensation quarter, this looks like one of the best in last 25 quarters. And net NPA ratio is at just 0.51%, which is the best in last 28 quarters. So CASA ratio, or the low-cost deposit ratio, has now crossed the 46% level, which is one of the best that you are seeing in last 16 quarters of 4 years. So cost to income ratio or operating efficiency, that's also one of the best in last 5 quarters. Annualized slippage ratio of just 1.83% is perhaps the lowest that you are seeing in last 8 quarters. Restructured book has also declined. Watch list has also reduced, which means that the stress in the balance sheet is actually reducing. The only flip side in the result was the deposit growth, which was around 10.1% YOY, one of the lowest deposit growth that you are seeing in last 6 quarters. So PNL, they have beaten our poll both in terms of NII and PAT. Brokerages remain bullish on the stock. They say that this is a time when the valuations are on the lower side, and the fundamentals now augur for a re-rating of the bank going ahead. They have raised estimates for FY23 anywhere between 8% to 14%, and for FY24 and 25 anywhere between 1% to 11%. So across brokerages, the new target price range is around 990 rupees on the low side and as high as 1,150 per share. Back to you.
All right, Abhishek, take that point on Axis Bank doing extremely well. But, I'm spotting an unusual mover in today's trading session, and that's Delhivery. I mean, Delhivery is down, 18% in today's trading session. And why just today? In fact, yesterday as well was down. In the last 2 trading sessions, it's seen some of the biggest intraday declines since listing earlier this year. The stock is down almost 30% in the last 2 trading sessions. As we speak, down 18.5% at the low point of trade. The second quarter update that came in post-markets day before yesterday did suggest weakness in sentiment as well as volumes, and the management expects some pickup coming by in the third quarter on account of the festive season. So in the last 2 trading sessions, we've seen a 28% dip, weakness in their second quarter performance, and as a result of which, from the post-listing highs, the stock is actually halved. Almost 46% correction is what we've seen, and from its issue price, it's down about 20% as well. And that means that a lot of the institutions who got it in the IPO are perhaps selling right now, because huge delivery volumes, and this is pun unintended, on delivery, the delivery volumes as of 12 p.m. are 42.2 lakh shares. And that compares with yesterday, which again was a high number, was 9 lakh shares. In the last 3 months, the average has been just around 3 lakh shares on a daily basis. So yesterday was 3 times that, and today is roughly 4 times yesterday's number. So 12 times higher delivery volumes on delivery. So some of the institutions definitely are selling under the IPO price. The company in the first quarter had said that, EBITDA loss, which had expanded to 198 crores, was because some of the unfavorable unit economics that came in. Capex took longer than expected to stabilize and unit costs were elevated. But importantly, the second quarter volumes were same as the first quarter, and first quarter is usually typically lower than the other three quarters. So if the second quarter is the same as the first quarter, that means, the first half has been weak. Let's see whether there is some pickup in the third quarter, which is the festive season, or not. But the street is not having, one bit of companies reporting any sort of miss and not doing well profitably.
Okay, well, let's wait by and see whether or not the EBITDA loss is probably as great as Q1. That was at 198 odd crores, like Manglam mentioned. But remember that a lot of these new age listings have also seen quite a deceleration in terms of the stock performance. Just the other day, Manglam, we were talking about Nykaa as well. Welcome back. Well, Axis's performance is definitely rubbing off on Kotak Mahindra Bank. So that one is now the second top gainer on the Nifty, up around 2.5%. HUL too doing well ahead of its numbers. So Hindustan Unilever from the FMCG space is gaining around 2%. But let's now go across to Manisha, who joins in with a guest for today. Manisha.
Well, thank you so much for that. I have with me Mr. Suvankar Sen. He's CEO Senco Gold and Diamonds, and he joins us today. Mr. Sen, hi, thank you so much, and a very happy Dhanteras and a Diwali festivities to you. When I look at the last year, it was the best Diwali quarter that we saw in 25 years. What are the initial sales trends showing right now, and how are you comparing this one to the last Diwali?
So the last Diwali being one of the best in the last 25 years was basically working on due to the base effect. And after the lockdowns that had happened, consumers were in a mode of euphoria. They were there to really explore and open up and buy for the kind of products that they needed. The wedding season was coming up, and all the weddings that were kind of postponed, though we were getting the results and the effect of all of it that made the Diwali what it was last year. This year, I would say that the situation is optimistic, but it is a cautious optimism with which the industry is working towards. The planning, the efforts, the endeavor, it's a different world from the last year. Everything has opened up. Globally, whatever be the case, India is very much protected. However, there is an impact of inflation, and consumers have become more busy. They have more options to spend upon. So the disposable income to spend on jewelry as a category only is not the only option, right? So as a result, we expect a growth in high single digit or a low double digit. But we still feel that, yes, the growth will be muted, but we all are expecting the growth to happen. Why? Because over the last 3 years, what we have seen, the economic scenario and the challenges, this year is not so challenging as the last 2 years, right? So therefore, there needs to be growth. There will be more liquidity in the market. However, you're just not fighting amongst the fellow jewelers, but with the other sectors.
All right. I also want to understand on who really is buying, because we do understand that millennials have started coming back into this market. So when you look at the age groups, millennials or older generation, where do you see more sales coming in?
So we have been seeing it for the last 6 to 7 years. What happens is that as the millennial or the young generation, maybe their first experience with the jeweler happens with their parents, with the mother, with the parents coming in and taking her to the jewelry store. But once that millennial is working and going out and has got the purchasing power to buy for herself, then she starts looking for jewelry that shall be her accessory and what will make her beautiful on her daily and casual wear that she wears. So this is where we are seeing that one aspect is, yes, the 40s and the 50s are matured buyers and they will be much more wiser and much more experienced in buying. But we are seeing young couples who have just recently got married, who are at like 35, 30 to 40 years. They are coming. We are seeing young people coming and buying jewelry who are at the age of 25 to 30, either coming with the parents or with a group of friends coming and buying a small piece of jewelry. What we have seen in terms of the kind of jewelry that are being bought is that around 25 to 30% of the products that are being sold is your casual and daily wear that gets sold.
I get that. So when you talk about millennials buying gold and jewelry as well, digital gold also seems to be faring quite well. So when it comes to that, how you as Senco are, getting into that space and position?
So we have started a platform, we call it mydigigold.com, where it's mainly made for the young generation, people who've become busy and want to buy it but has not got the time to frequent the stores as much as they would like to. So through that platform, a consumer for as low as rupees 250 can buy the gold, and they can keep accumulating it for for themselves. And as a responsible brand, we are keeping the gold on custody, as a trust on behalf of the consumer. And then it is physically backed. It's physically backed by gold in a third-party secured vault, fully insured. So just like all the jewelers have a monthly installment scheme where every month a consumer is paying money, saving towards the final purchase. This is just a new age digital way of buying gold at various prices throughout the month, throughout the year, anytime, as per the consumer's need and convenience. And then the jeweler, as a jeweler, are keeping it on the behalf of the consumer. And ultimately, the consumer has the option to either sell it back or to buy jewelry and redeem the gold that they have accumulated. So this is a new age product for the new generation. We are seeing certain tractions. There have been consumers that have subscribed to it. Our existing customers are also opting out for buying gold in this manner, saving it in the form of gold, and over a period of time then redeem it against jewelry.
So there's a product for every age group and every kind of a buyer here. But the festival sales start over the weekend, and it's an extended festival weekend. How are you looking at the numbers? How is it faring?
This time the Dhanteras is over a weekend. There are 2 days of it. So it actually starts on Saturday evening and it goes on till late evening Sunday. So consumers will actually be able to enjoy and get a much wider period of time for the Tithi, as we call it, the auspicious time to buy your gold and silver and diamonds and your jewelry. So that is one aspect of it. People will have enough time to spend with their family at the jewelry stores. So that will work in favor of us. And at the same time, we have seen that the pickup in the market has also started happening in the last 7 to 10 days. In the beginning month of this particular month, because there was already Navratras and the focus was very different in terms of the Navratras. And as people, how does it work out if looking at the upper middle class? They get the salaries, they get the bonuses, and then they start thinking of purchasing.
All right, Suvankar, thanks a lot for joining in. Thank you, Manisha, for taking us through with that conversation as well. Though I'm personally interested in what kind of friends go and buy jewelry, because as friends, we probably go ahead and buy a pizza. Maybe
what
get
are
a
you
couple
buying, Sonal, over the weekend? That's what I'm interested in.
Sure. What are you buying?
Welcome back. We have CSB Bank management joins us now after reporting their second quarter earnings. The company's net profit and net interest income rise while asset quality remains at a stable level. However, due to perhaps some weakness in the PLN, we are seeing a decline in the stock price. We have with us the MD CEO joining us to detail those numbers. Thanks a lot, sir, for joining in. That's the first question. With a strong loan growth that you've reported, that doesn't seem to have translated into the P&L. I mean, your net profits are up just about 1.5%. Can you tell us why that is?
Thanks, Mangalam, for having me. Yes, we had a very good loan growth. I think we are almost close to 25%, 24.1% loan growth year on year. We also had a reasonable growth on the balance sheet size. Having said that, I think on a year-on-year basis, the profit is up 30%, which is we think is reasonably good. Quarter on quarter, of course, we had two issues to be taken care of. If you look at it, our non-interest income, while core non-interest income has grown by more than 40%, but we took some hit on the treasury this quarter. So that has impacted our non-interest income a little bit. So from that perspective, I think this is because of the interest cyclicality, and also because of certain hit we took on our SR portfolio, which almost I think we don't have much of a SR portfolio left with us anymore. So given that perspective, I think on the core businesses, which is core non-interest income, core NIM has actually improved compared to last quarter as well. Obviously, we cannot hold that kind of a NIM in the long run. And overall, I think we are looking at growth. We have always been told by our investors and everybody that look at growth, and that is something which you have started growing. So overall, I think we are pretty happy with our quarter results, and on a compounding growth story, we should be able to see the profitability improve.
Okay. So just a quick word on the asset quality. What were your slippages as compared to last quarter as well as recoveries? And what is your guidance?
Slippages were pretty flattish compared to last quarter, almost similar. We also had recovery from both the write-off pool as well as upgrades were also quite good. So our hence net credit cost continued to be negative. Now that's too good a story to be true for too long. Last quarter was negative. This quarter is also credit cost is negative, net credit cost. So obviously some amount of credit cost will come back as we get into the next 2-3 quarters. But overall, I think our broad guidance has been that we'll be below 1% on net NPA and 2% on gross NPA. We are well below that. We are 0.57%, I think, on net NPA, and gross also have improved over last quarter. So I think we have no challenge at all on that side. We are looking good.
You said the NIMs won't sustain at such high levels. Could you give us a number of NIMs that you're looking at going forward in terms of a broad range? And loan growth at 24-25%, is that sustainable? What's the target for this year?
So even last quarter I had said this, that we will try to do better than the system. I think overall credit growth has improved in the system, but I think, we still don't know, but we seem to have done better than the system, and we will try to look at it that way. In terms of NIM, yes, I think we are above 5.6% right now. We will be closer to 5 as you know that the cost of funds are going to go up eventually as the cost gets as new cost and new deposits are getting booked at a higher price. So given that perspective, I think we should be happy if we are able to hold it somewhere around 5%.
Okay, we're going to leave it on that note. Thanks very much for joining in and speaking with us. The stock CSB down around 3% odd. The company is guiding on margins probably coming in at around 5% on a sustainable basis as compared to the peak of 5.6% that they reported. Loan growth steady, up around 24% this quarter. Gross NPA should probably be around that 1% range. Well, with that, it's also a wrap on Halftime Report. Business Lunch just after a short break. Thanks for watching.